Real estate versus stock market. Which one actually makes you richer? Two friends, same starting salary, same age, same city, same $40,000 savings account sitting in the bank doing nothing. One of them took that money and put a down payment on a rental property. The other put it into a stock market index fund and never touched it again. 10 years later, they sat down at the same kitchen table to compare numbers, and what they found surprised both of them. Today, we're settling the biggest, most argued about debate in personal finance: real estate versus the stock market. Not with opinions, not with hype, not with some guy on social media standing in front of a rented Lamborghini telling you to buy his course. With actual math, real numbers, real risks, real trade-offs. By the end of this video, you will know exactly which strategy makes sense for your life, your income, your city, your personality, and your tolerance for stress. Because here's a secret nobody tells you: the best investment isn't the same for everyone. It depends entirely on who you are. Let's get into it. Hey everyone, welcome back to the channel. Today I want you to meet two people. They're not real, but you've definitely met versions of them in your own life. Maybe at a family dinner, maybe in a group chat, maybe even in your own head when you're deciding what to do with your savings. The first is Jake Moy. Jake is 32 years old. He's read every real estate book he can find. He talks about leverage like it's the secret password to wealth. He uses phrases like "the bank's money, not mine," and "making money while I sleep." Jake owns 2 rental properties and is constantly looking for his third. The second is Marcus O. Marcus is also 32. He works a steady job, contributes a fixed amount to his investment account every single month, and has never once tried to time the market. He believes in something called a total stock market index fund, and beyond that, Marcus believes the less he does, the better his results tend to be. Both Jake and Marcus are convinced their strategy is superior. Both of them have stories to back it up. Both of them, frankly, are a little smug about it. So today, we're going to let both of them make their full case. Then we're going to do something neither of them really wants. We're going to look at the complete numbers, including the parts they tend to leave out. Grab a notebook if you want, because we're going to walk through some real math today. Jake's case: real estate. Let's start with Jake, because his story is the one that gets people fired up at parties. Jake's pitch always starts the same way. He leans in and says, "Why would I put my money into a stock I don't control when I could use that same money to control an entire $250,000 property?" This is the first concept Jake wants you to understand, and it's a genuinely powerful one. It's called leverage. Here's how it works. Let's say there's a property listed at $250,000. Jake doesn't need $250,000 in cash to buy it. Most lenders will let him put down somewhere around 20%, so $50,000, and the bank covers the remaining $200,000 through a mortgage. Now here's the part that gets Jake excited every single time he tells this story. If that property's value increases by 10% over a year, which, depending on the market, isn't unusual, Jake didn't just gain 10% on his $50,000 down payment, he gained 10% on the entire $250,000 asset. Let's do that math together. 10% of $250,000 is $25,000. Jake invested $50,000 of his own money. $25,000 divided by $50,000 is 50%. 50% return in 1 year on paper. This is leverage in action, using a relatively small amount of your own money to control a much larger asset, so that even modest percentage gains on the full asset translate into outsized percentage gains on your actual investment. Jake's second big argument is tax advantages, specifically something called a depreciation. Here's how this works, and it sounds almost too good to be true the first time you hear it. The government allows real estate investors to deduct a portion of a property's value every single year, treating it as if the building is wearing out, even if the property is actually going up in value in the real world. So on paper, for tax purposes, Jake's property might show a loss. Maybe he reports negative income on that property to the tax authorities. Meanwhile, in his actual bank account, rent checks are coming in every single month. He gets to keep real cash flow while reporting a paper loss. It's one of the most talked about advantages in the entire real estate investing world, and it's something stock market investors simply do not have access to in the same way. And then there's the part that feels the most rewarding day to day: cash flow. Every month a tenant pays rent. Some of that rent covers the mortgage payment. Some covers property taxes and insurance. And whatever is left over goes straight into Jake's pocket. To Jake, this feels different from watching a number tick up and down on a stock app. This feels like real, tangible income. Money he can see. Money that shows up in his checking account on roughly the same day every month. Money tied to something physical he can drive past and point to. Jake will also tell you about appreciation on top of cash flow. The idea that he's getting paid monthly and the underlying asset is, hopefully, growing in value at the same time. 2 ways to win, he says, instead of one. It's a compelling pitch. Leverage, tax breaks, monthly income, and appreciation all rolled into one. No wonder Jake can't stop talking about it. Sounds incredible, doesn't it? Free money from the bank, a tax break that pays you to own something, and a check every month like clockwork? Well, hold on. Because Jake conveniently left out several things. Big things. The kinds of things that don't come up in his stories, but absolutely show up in his actual bank statements if you ever got to see them. Let's talk about what Jake doesn't lead with. First, vacancy. Properties don't always have a tenant sitting in them, paying rent like clockwork. Tenants move out. Sometimes they give proper notice. Sometimes they don't. Finding a new qualified tenant can take weeks. In a slower market, it can take months. During every single one of those vacant weeks or months, Jake is still paying the full mortgage, the property taxes, and the insurance. Except now there's no rent coming in to cover any of it. A property that sits empty for even 6 weeks out of the year has just lost over 10% of its potential annual rental income. That's not a rare, unlucky event. That's a normal part of owning rental property. Second, maintenance. This is the unglamorous side of real estate that never makes it into the success story at dinner parties. The water heater fails in the middle of winter on a Friday night naturally. The kitchen faucet starts leaking and slowly damages the cabinet underneath it. The tenant calls because the air conditioning stopped working in the middle of a heat wave, and now it's an emergency that needs to be handled within 24 hours. None of this is optional. None of it can be postponed indefinitely. It's simply the cost of owning a physical, aging structure that people live inside of every day. Third, and this is the one new investors almost completely underestimate, capital expenditures. These are the big ticket items that don't happen every year, but when they happen, they hit hard. A new roof, a new heating and cooling system, repaving a cracked driveway, replacing old plumbing throughout the entire house. These kinds of repairs can easily run $10, $20, even $30,000 in a single event. They don't happen annually, but maybe once every 10 or 15 years per major system. But smart investors set aside money every single month specifically for this, because when the roof finally needs replacing, it needs replacing now, not whenever it's financially convenient. Fourth, time. Owning a rental property is, in almost every meaningful sense, running a small business, screening potential tenants, collecting rent on time and dealing with it when someone is late, coordinating repairs with contractors, fielding the 11 p.m. phone call about a pipe that just burst. Even if Jake hires a property management company to handle all of this for him, that typically costs somewhere around 8 to 10% of the monthly rent collected. That fee comes directly out of his profit every single month, whether he actively manages the property or pays someone else to do it. So when you add it all up, vacancy, maintenance, capital expenditures, property management, taxes, and insurance, Jake's simple napkin math of rent minus mortgage payment equals profit falls apart pretty quickly. The real number that matters is something called cash-on-cash return, the actual profit Jake walks away with every year, divided by the actual cash he originally put into the deal, after every single one of these hidden costs has been subtracted. And here's the uncomfortable truth that doesn't get talked about nearly enough. That real number is very often significantly smaller than the exciting 50% figure Jake threw around earlier. Many real, professionally run rental properties land somewhere in the range of a modest, single-digit to low double-digit, cash-on-cash return once everything is properly accounted for, still potentially solid, but nowhere near as dramatic as the leverage story made it sound. So before you get starry-eyed over someone's leverage story, run the real numbers first. Not the napkin version, the full version with every cost honestly included. Because here's the truth. Real estate can still be a powerful investment, even after all these hidden costs. But it only works if you go in with your eyes wide open. The investors who fail aren't the ones who picked the wrong property. They're the ones who did the exciting math and skipped the uncomfortable math. Know the full picture, then decide. So here's the bottom line. Real estate is not a get-rich-quick scheme. It's a business. And like any business, it rewards the people who do the hard, boring work of knowing their real numbers, not just the exciting ones. Yes, leverage is powerful. Yes, the tax advantages are real, but so is the vacancy. So is the roof. So is the midnight phone call. If you go in with your eyes open, treat it like a business, and account for every cost, real estate can absolutely change your life. But if you go in on napkin math and hope, that's not investing. That's gambling with a mortgage attached. Know your numbers, make your decision, and whatever you choose, commit to it like a professional. See you soon in the next one.